The holding company lie that nobody talks about. If your accountant has ever said to you, have you thought about setting up a holding company? Then this video is for you, because holding companies are sold to UK business owners as the ultimate tax solution. Move money around the group, protect your assets, avoid taking money out personally. Smart, efficient, tax savvy. But here's the thing, and a lot of that is true, but there's a critical piece of information that most accountants either don't know or don't tell you. A holding company does not eliminate corporation tax. Let me say that again. A holding company does not eliminate corporation tax. The money sitting in your holding company has already been taxed at up to 25%. Every pound that moved up from your trading company arrived there after HMRC took their share. So yes, the holding company protects you from taking it out personally and paying the income tax on top. That's a real benefit. But the corporation tax, that's already been paid up. And most UK business owners don't realize that there is a completely different approach, one that addresses the problem before the corporation tax bill is even created. My name's Huzaifa Voraji. I'm the founder of Evolve Tax. We help UK business owners restructure so that money flows back into their holding company without creating a corporation tax bill in the first place. Today, I'm going to walk you through exactly how holding companies work, what the real advantages are, where the limitations are, and what the smarter alternative looks like. Let's get into it. What is a holding company? What a holding company actually is. Let's start at the basics, because I find a lot of business owners have a holding company set up and aren't entirely sure how it works. A holding company is simply a company that owns shares in one or more other companies. It doesn't trade, it doesn't sell anything, it just sits at the top of a group structure and owns the operating companies underneath it. So your structure might look like this. You personally own a holding company. The holding company then owns your trading company. Your trading company is where your business actually happens. The sales, the staff, the contracts, the revenue. When the trading company makes a profit, it can pay a dividend up to the holding company. That dividend, in most cases, is received tax-free in the holding company under something called the substantial shareholding exemption and the intercompany dividend exemption. So the money moves up tax-free. It sits up in the holding company. And you, the individual, haven't personally received a penny of it. So you haven't triggered personal income tax in the eyes of HMRC. That's the basic holding company structure. And on the surface, it sounds brilliant. So why am I saying it has a problem? The real advantages of a holding company. Why your accountant is right to a point. Let me be fair here, because holding companies do have genuine advantages, and I want you to understand them properly because they do matter. The first advantage is asset protection. When profits sit in a holding company, rather than in the trading company, they are protected from the trading company's risks. If your trading company faces a legal claim, a bad debt, a failed contract, the assets sitting up in the holding company are ring-fenced. The holding company is a different legal entity. Creditors of the trading company cannot automatically reach into the holding company, and that is genuinely valuable. Advantage number 2, tax deferral on personal income. This is the big one your accountant talks about. If you take money out of your trading company personally via salary or dividend, you pay personal income tax. It could be at the higher rate, 40%, 45%. But if instead your trading company pays a dividend up to the holding company, that movement is broadly tax-free. The money sits in the holding company. You haven't personally received it, so you haven't paid any personal tax on it. You have deferred that personal tax, potentially indefinitely, if you never need to take it out personally. That deferral is worth real money over time. Advantage number 3, investment and reinvestment. Money pooled in a holding company can be redeployed into new businesses, property investments, shares or other assets without you personally receiving it and paying that income tax on it first. The holding company acts as a clean investment vehicle. Advantage number 4, flexibility across a whole group. If you own multiple businesses, a holding company lets you move cash between them efficiently. Surplus cash from a profitable trading company can be lent or gifted to another entity in the group that needs capital, without the money ever leaving the group and triggering personal tax. Advantage number 5, succession planning. A holding company structure can make it easier to pass shares to a family member, bringing in business partners or prepare for a sale in a tax efficient way. These are real legitimate advantages, and if your accountant recommended a holding company, they weren't wrong at all. But here's what they may not have told you. The fundamental limitation that nobody ever talks about or nobody ever mentions is the problem with every holding company. Here's the honest truth about holding companies. Every single pound that moves up from your trading company to your holding company has already been taxed. Let me show you what I mean. Your trading company turns over £2 million. It makes £600,000 profit. HMRC takes 25% corporation tax. So that's £150,000 gone. You are then left with £450,000 in after-tax profit. You then pay that up to the holding company as a dividend, and it arrives in the holding company tax-free. But the reality is this: you started with £600,000 in profit. You now have £450,000 in your holding company. HMRC still took £150,000. That money has still gone. The holding company didn't solve the corporation tax problem. It just gave you a clean vehicle to hold the money that survived the corporation tax. And here's what makes this worse. If you then want to take that money out personally from that holding company into your personal account as dividends, you will pay income tax on that too. So the journey of your profit is basically this. Your trading company has £600,000 profit. After corporation tax is £450,000. And then after personal income tax, if you draw it down at the higher rate, roughly about £270,000. You started with £600,000. You personally end up with about £270,000. HMRC got £330,000, more than half. The holding company helped you defer the personal tax, but it did not help you avoid the corporation tax. And this is the gap. And this is what most UK business owners never address, because most accountants aren't set up to solve this part, but we are. Holding company versus the evolved tax structure. Two routes, but one that costs you twice. So let me put two structures side by side, so you can see exactly what the differences are. Route one, the standard holding company. Your trading company makes £600,000 profit, corporation tax at 25%, so £150,000 to HMRC, £450,000 moves up to your holding company. That's where it sits. It's now protected from personal tax just for now. But corporation tax has already been paid every year on every pound of profit. Over 5 years with consistent profits, you have paid £750,000 in corporation tax before a single penny reaches your holding company. The evolved tax structure. Before the corporation tax bill is calculated, your UK company, the trading company, pays royalties and marketing fees to your UAE entity, because your UAE entity owns the trademark in the UK for your brand. Those payments are legitimate business expenses. They reduce the taxable profit in the UK. On a £2 million turnover business, we can charge a 5% royalty and 7% in marketing costs. Let's just say hypothetically, keeping the figures conservative, because the royalties could be anything between 3 and 8%, depending on your benchmark study report, and your marketing could be anything between 5 and 12%, depending on your benchmark study report. And that is what's needed to prove the value with HMRC. But if we were using the figures of 5% royalty and 7% marketing fee, that then creates £240,000 in deductible charges. So your UK taxable profit drops from £600,000 to £360,000. And then your corporation tax drops from £150,000 to £90,000. So you've effectively saved £60,000 in year one. That 240k that flowed to the UAE, that income sits in your UAE free zone entity at 0% tax or a maximum of 9% corporation tax. Now, here's the part that really matters. The money that's in the UAE can be returned to your UK holding company as a dividend if structured correctly. And under the UK's dividend exemption rules, dividends received by a UK holding company from a foreign subsidiary are broadly exempt from UK corporation tax. So let me say that a bit more clearly. The money flows from the UAE into your UK holding companies, no corporation tax, no personal tax. So your holding company receives that funds and they've never been subject to 25% corporation tax. Now your holding company's got this extra money and HMRC effectively has less. And your holding company can decide to go buy an asset or anything completely legally. So if we were to do this over a 5-year period, the difference between the two routes are insane. Because on a business turning over £2 million, the gap between how much you'll save with a normal UK holding entity structure to a structure that we create for you is incredible. And that's what we build for our clients. So how the money actually flows. Follow the money step by step. Let me walk you through exactly how the money flows in our structure. So I want this to be crystal clear. Your first step, your UAE free zone company owns the intellectual property, the brand, the trademarks, the systems. Your second step, your UK trading company pays royalties and marketing fees to the UAE company. under a formal intercompany licensing agreement. This is something, by the way, we do everything in the background for you. And these payments that you made are tax deductible in the UK. So you're saving the corporation tax in the UK. The next step is that royalty fees and the marketing fee income, it sits in the UAE entity. And depending on the amount, you'd either pay 0% corporation tax or 9% in corporation tax. That's the maximum, not 25%. And bear in mind that the 9% corporation tax is only after £75,000 of profit. 375,000 dirhams to be precise, so you'd have to work out the foreign exchange at that time. But you pay 0% on that amount. It's only on the difference you'll end up paying 9%. Now, the fourth step is that the UAE entity pays that dividend to your UK holding company because your UK holding company owns the shares in the UAE company. And under the UK tax rules, dividends from foreign subsidiaries are generally exempt from UK corporation tax in the hands of the holding company. So then the money arrives in your UK holding company. It's clean, it's tax efficient, with no 25% UK corporation tax charge on the way. Now, your UK company has the funds that can be reinvested now. It could be deployed within your group structure to other businesses, used for property, investment, or then if you choose, you can take them personally and pay the dividend tax. But you can take it at a time that suits you. And here's an important distinction. We're not telling you to never pay corporation tax. Your UK trading company will still pay corporation tax on the profit that remains in the UK. We're not eliminating it completely. What we're doing is ensuring that a significant portion of your profit moves through a more efficient route before that tax bill is even calculated or even created. And the result in the end is basically a lower corporation tax bill. In turn, you got more money in your holding company, a structure that what we do is make sure that it is fully documented, fully compliant, and built to withstand HMRC scrutiny. So what does HMRC actually say about this? Is it legal? Here's what HMRC actually says. And I know what you're thinking. This sounds too good to be true. But what does HMRC actually say about this? Their answer is they've written the rules. And when you follow those rules correctly, it's entirely lawful. So the UK's corporation tax system has allowed deductions for legitimate business expenses. Royalty payments for the use of intellectual property are a recognised, accepted, deductible expense. The exemption for dividends received from foreign subsidiaries is written into UK tax law. It exists specifically to prevent double taxation of international business income. HMRC did not create this rule by accident. Parliament did. And there's always a reason why. For example, Starbucks paid 6% of UK revenue as royalties to a foreign entity last year. Nike held intellectual property in low tax jurisdictions for decades. These structures were scrutinised at the highest level. And HMRC's objection was never that the principle was wrong. Their scrutiny was always about whether the rules were followed. And that is exactly where we come in. The rules HMRC look at are these. Is the royalty rate commercially reasonable? Is the transactions at arm's length? Is it benchmarked against market comparables? Does the UAE entity have genuine substance? Real office, real staff, real management? Are the intercompanies legally drafted? Are they watertight? Has the transfer pricing been properly documented? Is the dividend exemption correctly claimed on the UK holdings company's corporation tax return? For every single one of these boxes that we address, it's in our documentation packs. We keep a track of this. We do everything. We design this. Every structure we build is designed to be opened in front of HMRC without any hesitation. Because the ones that fall apart are the ones built without any proper documentation, not the ones built by specialists. The numbers that change everything. Let me show you what this looks like across different business sizes. And I'll compare the holding company route against the evolved tax structure. Because £1 million turnover, £250,000 profit. If you went down the holding company route, you'd still pay corporation tax at 25%, £62,500. 187,500 moves to a holding company. Now, if you look at that exact same figures, on the evolved tax structure, if you look at 5% royalty, 8% marketing fee, let's just say, it equals £130,000 in expenses. So your taxable profits reduced to £120,000. Your corporation tax is only £30,000. Your saving on corporation tax is £32,500 in just year one. Now that £130,000 flows to the UAE, returns to your UK holding company as a dividend. No additional UK corporation tax on arrival. Your holding company ends up with more. HMRC ends up with less. Now look at different figures. £3 million turnover, £700,000 profit. The holding company route, corporation tax 175,000. 525,000 moves to the holding company. If we do an evolved tax structure, 5% royalty, 7% marketing, that equals £360,000 in deductible charges. So your taxable profit has now reduced from £700,000 to £340,000. Now the corporation tax at that is £85,000. So you're actually saving £90,000 in year one. £360,000 flows to the UAE, then returns to your UK holding company, tax-free on arrival. Call me Mr. Duty Free. Another example, £5 million turnover, £1.2 million profit. If you go down the holding company route, you're going to pay corporation tax of £300,000. You'll end up only moving £900,000 into your holding company. Now let's be a bit more reserved with the figures, a bit more conservative with the figures for the royalties and the marketing. Let's just do 4% and 6%. So £500,000 in tax deductible charges, and your taxable profit reduced to 700k. So your corporation tax is now £175,000. So your saving in year one is £125,000. So it just makes complete and utter sense if it's done correctly. That £500,000 flows to the UAE, could come back to the UK holding company. You can go buy a house with it. You can invest in businesses, move it across your group. And if you look at over 5 years, business saves, £625,000 in corporation tax compared to a standard holding UK company structure. And that money isn't gone. It's in your holding company. It's working for you. You can still move it across your group. You can still invest. It's still available for you to grow. Now, what are the questions I get asked every single time? I'll answer them for you. The first question I get asked quite a lot is, can I do this alongside my existing holding company that I've already got in the UK? Yes, absolutely. It's actually an advantage that you've already got a holding company. The evolved tax structure just sits alongside it. Your UAE entity feeds dividends into your holding company. Your holding company continues to do what it was doing before. Everything it already does, asset protection, group cash management, investment vehicles, succession, planning, whatever. We just give it a far more efficient source of funds. Second question, do I have to move to the UAE? No, you don't have to move to the UAE. You can still be a resident in the UK for tax purposes. You can remain in your business. The entity is a separate legal entity. It may require you to come here for a couple of weeks initially if you need residency. It requires real substance, a real office, real staff, a general manager, all of which we do for you. But you don't have to move your life here. My accountant hasn't mentioned this. Most accountants don't, because this sits at the intersection of international tax law. They won't know the law in the UAE, UK transfer pricing rules, HMRC's anti-avoidance framework. And a lot of accountants just do compliance, and that's where they build their money. But this is where we come in. We work with accountants in the UK, and accountants always are referring our services to us. It's literally what we do every single day. Another question I get, is it just for large businesses? No, we work with businesses from £500,000 turnover upwards. The structure scales with your business, and the real honesty is that you need to implement this early, because it'll save you time and you're not firefighting. You've got everything in progress, or everything's there already in writing that this is what's going to happen before you grow, so that there can't be any questions asked. What if HMRC investigates? That's a question I will get all the time. Every structure we build is designed to be investigated, and that's why we document everything. So a lot of companies in the UAE, people that are competition, etc., will set up a business for you, and that's it. You're left to your own devices. Whereas for us, what we're trying to achieve is not just set your business up and invoice your company in the UK and it'll be fine. You can still stay in the UK. No, that's not how we operate. What we're trying to achieve is something that holds up to HMRC. It's defensible, and we document everything: transfer pricing study, benchmark agreements, intercompany agreements we create for you, your substance evidence file, we do that, your CFC, control foreign entity compliance file, or control foreign company, withholding tax clearance if it's required, your annual compliance calendar. If HMRC was to open an inquiry tomorrow, we literally open our folder, and that's the difference between us and as an advisor who builds international structures compared to people that just do company setups. In order to kind of summarize, and the quite honest summary of this, and this is being completely straight with you, a holding company is a good structure. It is a very good structure. It protects assets. It defers your personal tax. It gives you flexibility. And if you don't have one, you probably should. That should be your starting point. But it doesn't solve the corporation tax problem. The money that lands in your holding company has already been taxed at 25%. That tax has already been paid. The holding company is a really good vehicle for managing money that survives corporation tax. What Evolve Tax does is addresses the problem upstream, because before even the corporation tax bill is calculated, we legitimately reduce what is taxable in the UK. We route income through a structure that is taxed at a fraction of the UK rate, if anything, and we return that income to your UK holding company as a dividend, and it is broadly exempt from UK corporation tax, and you're paying no tax on it whatsoever. And that effectively is a result that you're having more money in your holding company, so you've got more money to invest, more money to grow your business, and more money to eventually pass on. You know, you don't have to choose between having a holding structure or being a client of ours. It works together. The holding company is ultimately the destination, but Evolve Tax, our structure, is the route that gets the money there without HMRC taking a 25% charge at the gate. What to do next? If you are a UK business owner with a holding company structure, or you're thinking about setting up one, I want you to do just one thing. Work out how much corporation tax your trading company paid last year, and then not income tax, just the corporation tax, the bill that your company paid before you were able to take dividends or before you took money into your holding company. Now imagine reducing that bill by 30, 40 or 50% legally with full documentation, and it's reviewed annually. So this is not a fantasy. This is what our clients experience. This is what we do. This is our job. This is our role. And if you want to book a free strategy call with us, go to www.evolvetax.co.uk. You can see my diary there. You can book in. Tell us your turnover, your profit. Tell us what you have in your holding company, and we'll show you exactly what the difference will look like for you. Not a generic illustration. It's your numbers. And every month you delay is another month your trading company pays 25% on profits it doesn't need to. Evolve Tax, intelligent structuring, proper compliance, and real results. Book your call today. Link is below.